Tens of millions of Americans are at risk, and the economic damage could be far worse than the tariffs. Almost one-third of borrowers, or about 5.8 million people, are delinquent on one of their loans, meaning they haven't made a payment in at least 90 days. That's up 21% in February alone, and the highest rate since the credit agency began collecting data all the way back to 2012. And before the pandemic, only about 12% of Americans with student loans were delinquent, and what this is an indication is there isn't enough money in the financial system. And we see this happen every time the economy slows down. There isn't enough new money created to pay on all the debts. And what happens is you start to see delinquencies rising. And what that means is we're headed right into a recession. And depending on how bad it gets, you could see an all-out financial crisis. Now, yesterday we talked about the rising delinquency rate in commercial real estate and how it could lead to a wave of bank insolvencies. Now what we're finding out with tens of millions of student loan borrowers, the economic impact could be even worse. The area of leniency for student loan borrowers, a lengthy period of forbearance and other concessions during the pandemic, has now officially ended. Since October, borrowers who missed payments have once again been reported to credit agencies, and delinquencies are now hitting credit scores in an unprecedented wave. And this is a major problem for a debt-based, consumption-based economy, because what you need is people to access credit and buy things they don't need with money they don't have. And that's really what powers the U.S. economy. So as we start to see delinquencies go up, what it means is it's going to impact the ability of tens of millions of Americans to borrow money, and you're going to see consumption that's already slowing down take an even bigger hit. TransUnion estimates about 1.8 million of the newly delinquent borrowers could reach default status by July. These borrowers who haven't made a payment for at least 270 days will then be subject to involuntary collections from the federal government, including wage garnishment or the withholding of tax refunds. So the key point here is that these borrowers are not making payments now, so that money is being spent out into the real economy. As soon as they go into default, they're going to have to start paying back on this debt. That means less money spent into the real economy. It's going to affect other workers' incomes and jobs, lead to a further slowdown, put more people on the unemployment line, and cause a further increase in the delinquency rate, and ultimately push us right down into a recession. And you can see that very clearly on this next chart as we take a look at advanced retail sales. This is inflation adjusted, shown in blue, against the delinquency rate on all consumer loans in red. And what you can see is periods of rising delinquencies leads to a decrease in spending. And it makes perfect sense, because if you can't access credit, you can't go out and spend. And you see that going into the dot-com bubble very clearly during the financial crisis. We see a little bit happening before the pandemic, and now we're seeing it again. So what we're facing here is a period of rising delinquencies. We know that retailers have already been struggling. They're trying to keep from raising prices. We know that some of them are going to have to. Consumers already rejecting prices where they're at, but without access to credit, spending is going to drop, retail sales are going to plunge, and we could see not only more consumers go into default and bankruptcy from this, but we could face a lot of small businesses, other business head into insolvency as well. But as far as the government, I want you to see why policymakers are going to make this even worse as we turn to Fed Chair Jerome Powell, who in front of Congress today had to say that if it turns out that inflation pressures do remain contained, then we get to a place where we cut rates sooner rather than later. But I wouldn't want to point to a particular meeting. I don't think we need to be in any rush, because the economy is still strong. And Fed Chair Powell, I don't understand how you can think the economy is strong when over 5 million Americans are in delinquency right now. And this is a clear sign that the economy is not working for a lot of Americans. It's slowing down, and what it means is if things don't turn around and fast, we're going to see the delinquency rate rise even more. And we know when that happens, demand goes down, and next thing you know, the unemployment rate goes up, and what you're fixated on is inflation, and it's going to turn and drop in a major way. But something our subscribers were a rush to get into and cashed in big on, and you could have as well. That was our trade on XLE. This went out to our Momentum Timer Pro subscribers back on the 10th. They got stopped out on the 23rd, made a nice 4.17% gain. And you too can get in on trades like this. All you have to do is grab those links in the description below. Use your coupon code for a free 30-day trial. Stay tuned to the end of the show. Because Powell acknowledged that recent data supported a case for lower rates, and it's very clear we are seeing the U.S. economy slow down, and he admits the data is saying that we should be cutting rates here. But I want you to see there's a major problem with the Fed right now, because Powell is fixated on inflation, and he wants to go down on the story that he brought inflation under control, and then he's held steadfast because he thought it was going to go up. Now the risk is if it doesn't go up like he said. And remember yesterday we looked at the S&P global data, which indicated it could go higher. But if Powell gets this wrong, well, the whole economy is going to tank. But he emphasized that the data was backward looking, and many economists expect a meaningful increase in inflation over the course of this year due to tariffs. Well, if the data we look at the economy is backward looking, and it is, then why are we using it to set monetary policy? We should be forward looking, but in this case, I think he's got it completely wrong. At this time, all forecasters are expecting pretty soon that some significant inflation will show up from the tariffs. We can't just ignore that. But here's the point. He admits that monetary policy is in a restrictive place. So what he wants to do is constrain demand at a point when what we're seeing is over 5 million borrowers go into delinquency. Their credit scores are getting hit. That means their ability to spend is going to go down. And yet he says that isn't enough pain. The pain in the commercial real estate isn't enough. He wants more to bring inflation down. And I just don't get it. I think he's completely wrong. But what do you think? Weigh in the comments below. Is he right or wrong? What would you do if you were the Fed chief? Because we can see that the Fed does react to inflation, but not very clearly. As we take a look at the consumer price index in blue against the federal funds rate in red, most of the time the Fed cuts rates ahead of a decline in inflation, but this time it's very clear inflation is coming down, but the Fed doesn't want to cut rates. Well, it's mostly because monetary policy is about the labor market. Now, if we start to see continued claim surge, watch the Fed start cutting regardless of where inflation is. But there is one thing to cut. But the one thing Fed Chair Powell is concerned about, and that is the fact that a lot of these producers are going to force inflation onto the economy. And if we go over to the New York data here, let's take a look at the current prices paid diffusion index for New York against the CPI, still shown in blue. You can see the wonderful relationship here, and this is what he's focused on. He wants to be right that inflation is going to go up, but what he can't see is demand is going down at a faster rate. As long as demand goes down, inflation gets contained. What you find out then is Fed Chair Powell is too late. And Trump said on social media Tuesday, I hope Congress really works this very dumb, hard-headed person over. We'll be paying for his incompetence for many years to come, suggesting that Fed Chair Powell, by keeping rates too high as the economy slows and inflation comes down, is going to push us right into a recession. Now, we can argue it's not just rate policy that will drive the economy down, but it certainly is not making things any better. Even so, increases in tariffs this year are likely to push up prices and weigh on the economy, Powell said. He said the tariffs' impact on inflation could be short-lived or possibly more persistent. But he knows better. He knows it's not going to be more persistent because in order to have persistent inflation, consumers need to have wage growth and the income to afford higher prices. What we're seeing is the exact opposite. We're seeing wage growth slow. We're seeing hours worked get cut. And with the unemployment rate ticking up slightly and continued claims sitting just shy of the 2 million mark that I think if it breaks out from, that you're going to watch out, that we're going to see a lot of people hit the unemployment line. Well, what we're seeing here is the Fed is making a major policy mistake and doing nothing to help any of these borrowers who are in delinquency. And what we're finding is consumer confidence is plunging now as Conference Board's gauge of confidence decreased 5.4 points to 93. A measure of expectations looking forward 6 months dropped 4.6 points as the share of respondents anticipating better business conditions fell by the most in 2 years. The gauge of present conditions fell 6.4 points. This month, retreat suggests consumers will remain guarded about their spending, and that's exactly what happens when confidence falls. So what we saw was a big decline in confidence, and as if consumers thought things were going to be far worse, that they thought inflation was going to surge higher. But when it didn't, they didn't see the economy turn higher, but their confidence went up a bit, thinking that, hey, the end of the trade war may actually make a difference. What they're finding out now is the economy is on a trajectory that even the end of the trade war isn't going to change. And when you see confidence falls, well, it means spending is going to go right down with it. And here we can see advanced retail sales against the University of Michigan Consumer Sentiment Survey. And very clearly, you start to see slowdowns in the economy, but when confidence goes, then spending tanks right along with it. And we know confidence is everything to do with finances, so when confidence is dropping, that means consumers are tightening their belt. And we can usually see with a lag, it means that retail sales are going to get worse. And even though there was a brief rebound in confidence, it didn't translate to an increase in spending. The fact of the matter is the confidence is plunging because right now the U.S. economy continues a downward trajectory. And the risk here is what Americans are facing is they're going to likely lose their job, see more hours get cut. And that means more Americans in delinquency, not just from their student loans, but we're going to see credit cards, automobiles, and houses and everything else follow suit. The share of consumers who said jobs were plentiful dropped to 29.2%, the smallest in more than 4 years, indicating that there's pain in the labor market and things here are getting worse. A small share of consumers said they expect their incomes to rise in the next 6 months, but this is fairly normal. Those who do have jobs always see their incomes go up during recessions or economic slowdowns, so that's not the factor. The problem is the people who aren't going to have a job. But at the same time, expectations about personal finances remain largely solid, but this is likely reflecting a rebound in U.S. equity markets and the outlook for stocks, having nothing to do with the outlook for the labor market, which we know is getting worse. And as that gets worse, we're going to see delinquencies go up in other places, particularly the housing market. As we now turn to Adam's latest data on the proportion of seriously underwater mortgages for the first quarter of 2025, again, you see further evidence that the economy is getting worse and there's a massive dollar shortage building. Here we can see nationwide that the percentage of seriously underwater homes nationwide increased from 2.5% in the fourth quarter of last year to 2.8% in the first quarter of 2025. And this indicates people who have a loan balance that exceeds their market value by at least 25%. So they know if their economy doesn't turn around that they're likely to go into default. The problem is for more Americans, it's going to get worse. And we're now seeing that across the Midwest. As layoffs from Trump's tariffs ripple across the auto parts industry, and this is something we haven't seen hit the economy yet because there have been enough jobs created to offset this. The problem is, as we see the economy further slow down, I think there's going to be a massive impact from the tariffs that nobody's expected. And we can see that companies like General Motors, Harley-Davidson, Magna International, and German parts maker Continental AG are cutting all of their capital spending. And as they cut, that impacts a lot of other business, including suppliers who are now being forced to lay off. But check this out. For a lot of businesses, financing is becoming a major problem because they need money to get through the slow period. In fact, they're noting that banks are drying up. They're not giving out as much credit. Contracts are being delayed, so companies are looking for alternative sources, and what they're telling us is they need money to bridge through the slow time until things turn around. But if you look at the economy, go back to the student loan borrowers, their rising delinquency rate doesn't tell us the economy is in good shape. The rising delinquencies in commercial real estate isn't telling us that things are in good shape. The fact that more Americans across the heartland that are supplying industries like the automobile sector that are facing job losses, that's not telling us that things are strong. And so while the Fed is worried about inflation, what they can't see is the economy is slowing down and the demand is going with it. And as long as the banks continue to constrict the creation of credit, well, we're not going to face inflation. We're going to face a financial crisis. Let's take a look at the consumer price index, still shown in blue against the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes. That's shown in red, and we can see going all the way back to the late 90s as firms tighten lending standards. Anytime the red line's above that horizontal black line, you see that inflation runs into a wall, rolls over, and heads down as we go right into a recession. And you can see that happens during the global financial crisis. You can see it's part of the reason why inflation came down. If consumers don't have access to credit, they can't spend. And now we're seeing more banks tighten lending standards. The notion that inflation is going to be a problem, that's not likely to happen. What banks are telling us is they're worried that the economy is getting worse. They want to prioritize getting their money back. And so as we look all the way back to student loan borrowers, we can see that this could be the tipping point that sends the U.S. economy not just into a recession, but into an all-out financial crisis. But even if the economy goes down, you can still make money trading. Let's take a look at that trade on XLE. Again, we made 4.1%. We got got in on the 10th, out on the 23rd, and how did our Momentum Timer Pro subscribers do it? How can you do it? Well, each and every day we look at the momentum signals and we look to find when they're coming out of oversold territory. Now we aggregate a number of them together, but when we pair it with a rising trend, we get a very strong signal. And when we see that, it shows up right on our hot list each and every day. Now you get the momentum indicators across a broad equity, bond, currency, and commodity markets. We give them to you on a 1 day, 1 month, 3 month, and 6 month window. But here's the best part. You get the daily report. You get all the tradable signals. I review the trades, give you my opinions on the best ones. We give you risk control levels, a full tracking of all our open trades and returns, a weekly update, and of course, a 30-day free trial. Now, why do we do that? Because we're so confident that you can make money trading our reports that we want your first 30 days to be on me. Grab those links in the description below. Use your coupon code for your free 30-day trial because we got some big things coming for our subscribers and you don't want to miss out. With that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.